Hey everyone, welcome back to TechMoneyAI. Today we're diving into a crucial topic for any investor, using AI to diversify your portfolio and minimize risk. If you've ever felt unsure about spreading your investments, this is the video for you. Stick with me, and by the end of this video, you'll know exactly how to use AI to create a balanced, diversified portfolio that's ready for any market changes. And before we jump in, make sure to hit that subscribe button and turn on notifications. Here at TechMoneyAI, we're all about helping you invest better with the power of AI. First off, what exactly is diversification? In simple terms, diversification is the practice of spreading your investments across different assets, like stocks, bonds, real estate, and even cash. The goal is to reduce risk, so if one investment loses value, the others can help balance it out. Imagine you've invested everything in one stock, and suddenly that company has a bad quarter. Your entire investment could drop. But if you have a diversified portfolio, maybe a mix of tech stocks, some bonds, and even some real estate, then that one bad stock won't impact your whole portfolio as much. It's like building a safety net for your investments. So, why use AI for diversification? Well, artificial intelligence can analyze massive amounts of data at lightning speed. It looks at current trends, historical data, market shifts, and even global news. AI can spot opportunities and risks across various asset classes, stocks, bonds, commodities, and more, in a way that would take a human hours or even days to figure out. AI can also help you create a balanced portfolio based on your unique risk tolerance and goals. It uses data, not emotions, to suggest where you should put your money, making it a powerful tool for diversifying your investments. Here's why using AI for diversification is smart. Risk reduction. AI helps you balance between high-risk and low-risk assets, which can reduce the impact of market volatility on your portfolio. Efficient decision-making. AI can analyze hundreds of stocks and market data in seconds, giving you insights into sectors or assets you might have overlooked. Objective decisions. AI isn't affected by emotions or panic. It makes recommendations based on data, which can help you avoid impulsive moves. Adaptability. AI can quickly adapt to changing market conditions, rebalancing your portfolio to keep it aligned with your goals. These are just a few ways AI can make diversification easier, smarter, and more reliable. Now, let's talk about some AI tools you can use to diversify your portfolio. Here are a few popular ones that can get you started. Betterment is a robo-advisor that uses AI to build and manage a diversified portfolio based on your risk tolerance. It automatically rebalances your investments to keep your portfolio on track, making it easy for beginners and experienced investors alike. Wealthfront is another robo-advisor that offers personalized portfolios. It considers factors like your income, goals, and investment horizon to recommend a blend of assets from stocks to bonds to real estate. Q.AI is an AI-driven app that creates dynamic investment kits based on themes like tech, energy, and emerging markets. It allows you to invest in a wide range of sectors and can adapt your portfolio as market trends change. M1 Finance allows you to create custom portfolios called pies that include various stocks, ETFs, and more. With AI-based portfolio recommendations, it's ideal for hands-on investors who want a bit of control along with automation. If you're finding this helpful so far, don't forget to hit that subscribe button and turn on notifications for TechMoneyAI. We're here to help you invest better with the power of AI and build a secure financial future. Alright, let's get into the steps of building a diversified portfolio using AI. It's actually easier than you might think. First, set your goals. Define what you want to achieve, saving for retirement, buying a house, or simply growing your wealth. Your goals will help guide your AI-driven portfolio. Next, choose your risk level. Every AI tool will ask about your risk tolerance. Be honest. If you're more conservative, AI might recommend more bonds and safer assets. If you're aggressive, you might see more stocks and high-growth options. Then select your AI tool. Choose a robo-advisor or AI-driven app that suits your needs. Remember, tools like Betterment or Wealthfront are great for beginners, while Q.AI and M1 Finance offer more customization. After that, fund your account. Start with an amount you're comfortable with. Most platforms allow low minimum deposits, so you can start small and add more over time. Finally, let the AI manage and monitor. Once your account is set up and funded, the AI takes over. It will automatically diversify, monitor, and rebalance your portfolio as needed. Your job is to sit back, monitor occasionally, and let AI do the heavy lifting. Let's look at a simple example. Suppose you're using Wealthfront with a moderate risk profile. Your portfolio might include 50% in diversified stocks for growth, 20% in bonds for stability, 15% in real estate for additional income, 10% in international stocks for exposure to global markets, and 5% in cash for liquidity. This blend gives you exposure to different assets, so if one sector goes down, the others can help offset it. That's the power of diversification. One major advantage of AI is automatic rebalancing. Over time, certain investments may grow faster than others, which can throw off your balance. AI tools like Betterment will automatically adjust your investments to keep your portfolio aligned with your goals. Rebalancing helps maintain your preferred risk level and keeps you diversified. If you're enjoying this content and want to learn more about AI-powered investing, be sure to subscribe to TechMoneyAI. We're here to help you invest smartly and securely with AI. Before we wrap up, here are a few final tips to keep in mind. Start small. Don't feel like you need a lot of money to start. Most robo-advisors let you begin with a low minimum. Stay consistent. Contribute regularly, even if it's a small amount. This can help you benefit from dollar-cost averaging. Monitor occasionally. Although AI manages your portfolio, it's still a good idea to check in every few months. This way, you'll stay informed and can make any necessary adjustments based on your evolving financial goals. Stay informed. AI is powerful, but understanding basic market trends and factors can still help you make better decisions. Staying educated on market trends and economic news can only enhance your confidence in your investments. Don't panic with market fluctuations. Markets go up and down, that's normal. Trust in the AI's data-driven approach and stick to your long-term plan. Diversification and regular contributions will help keep your investments on track over time. Thank you for joining me on this journey to explore how AI can help you build a diversified investment portfolio. With AI, diversification has never been easier, smarter, or more accessible for all kinds of investors, from beginners to seasoned pros. If you're ready to leverage the power of AI to minimize risk and grow your investments, then don't wait. Start exploring the options we discussed today and see how AI can make a difference in your portfolio. And don't forget to subscribe to TechMoneyAI and turn on those notifications. Here, we're dedicated to helping you invest better with the power of AI. Let us know in the comments what AI tools you're excited to try, or if there's a topic you'd like us to cover next. Thanks for watching, and I'll see you in the next video.